welcome back. You're still watching Business Lunch on CNBC TV 18. This market is definitely in a mood to punish anything that even smells of bad news. The cases in point, IRB Infra down about 7%, weak margins there. A whole host of other stocks, under quite a bit of pressure. I mean, Jet Airways, no deal come through, down about 2%. And Reliance Communications, the less said the better, down almost 21%. Huge, volumes traded there. But let's talk about more stocks in the news. Jubilant Food trades with cuts after the company comes under the National Anti-Profiteering Authority scanner for not passing on the tax benefits via the GST route. Mangalam, there's a 40 crore penalty, I guess, right?
That is what it is, a 40 crore penalty coming in from the National Anti-Profiteering Authority. Remember, last November, the GST rate on restaurants was cut from 18% to 5%. But the caveat was this was minus the input tax credit. So the NAA says that the company profiteered almost about 42 crores by not passing on GST rate cuts. So that is taking the stock lower. On its part, the company has issued a clarification to the exchanges. They said that they passed on the benefits of the GST reduction with immediate effect, and the loss due to input tax credit withdrawal was far higher than the price increase that the company took. In fact, the loss due to input tax credit is something that the NAA hasn't calculated, so they are exploring their options to engage in conversation with the NAA. We haven't heard the end of it, but remember, fundamentally nothing has changed from the company. Sonia, last week itself we were looking at the results where the revenue, EBITDA margins and the net profit beat estimates. The same store sales growth came in higher. The stock rallied a bit, and today is just a one-off where the stock is down about 4% on account of a news that it's a 42 crore penalty for which the company is exploring more options. But then again, this is just a one-off.
One-off and no impact on the operational performance at all, right? People are still eating more and more pizzas as we figured out when the numbers came last week. But Punjab National Bank reported its numbers just a while back. Abhishek is here to tell us how the numbers look this time around. Abhishek, better than expected?
Well, it is better than expected because of the fact that slippages are on the lower side in last 4 quarters, and that resulted in the bank reporting a profit for the first time in 4 quarters. So the gross NPA in absolute value declined by 4.3%, and the ratio came down to 16.33, which is one of the lowest in last 4 quarters. The ex of Nirav Modi, the provision for NPA was just at 546 crores. But on the negative part, you look at the loan growth. Now, loan growth has declined for the first time in 8 quarters, and it is the worst in last 10 quarters. So, but another key worry that I have for PNB is last year, FY18, the bank has reported a loss of 12,200. You look at the numbers right now, 9 months, the bank has reported a loss of 5,200 odd crores. So for FY19 to be profitable, first, the bank has to, make up for these losses and bring down its net NPA to below 6%, which would lead to additional provision of more than 9,500 crores. So 2 consecutive years of negative ROA can lead to a bank falling under PCA framework. Along with that, the net NPA is above 6%. Just a key worry over there.
All right, Abhishek, thanks a lot for that. Just a key worry, all the points put on the table. But we have numbers coming in from BHEL. Net profit at 192 crores. This compares with the CNBC TV 18 poll of 260 crores. We'll try to get in some more details, but looks like the bottom line is a big miss to the tune of about 70 crores. And the stock also notably taking note of that, lower by about 3. Okay, it's recovered from the lows of the day. So let's try and get in some more details. Revenue has been pretty much in line with what the street was working with, actually. 7,336 crores compares with our poll of 7,375 crores. So it'll be important to see what the company has done on the operational front, given the sort of decline that we've seen with regards to our poll on the net profit. Any more details that you have, Sonia, right now? Because looks like it's a miss on the bottom line.
It is a miss on the bottom line, definitely, but we need to see what the operational performance is for the company. Remember, in any case, margins are expected to be in low single digits of around 6%. But still, on a year-on-year basis, I think the expectation is that margins would pick up. So let's wait by. But for now, the stock is under a lot of pressure because of the operational miss, perhaps, that the company is in. Net profits well below what the street was estimating, and below, just a tad bit above what they did same time last year. So 150 crores is what they did same time last year, and this time it's coming at around 190 crores or so. The order inflow and what the executable order book is something that we're going to watch out for. Anisha, by the way, is here to give us a snapshot of what she's made of the numbers. Okay, there the EBITDA is, oh, it's a huge miss. 200 crores EBITDA.
Well, yes, I was looking at the segments to figure out what is the margin picture looking like, and look at the power segment EBIT. That's coming at 592 crores versus 772 crores, and this is despite the top line being pretty much stable on a year-on-year basis. So definitely there's a margin miss as far as the power business is concerned. We know there have been a lot of one-offs with BHEL in a lot of these quarters, given they had taken some provisions, etc. But this time, given it's in the segment, it looks like it is a margin miss. They haven't really given the order book detail, which they usually give in notes of accounts. But other than that, the top line is just in line or even less than what we expected. The bottom line is a miss, and that is because the operational performance of the company is weak. This time, employee benefits has not really gone up. That is again stable at 1300 crores, because usually it is a year-on-year impact of the employee cost in BHEL that really impacts the margin. But this time, it looks like the cost of material consumed has gone up to 5,000 crores versus 4,000 crore reported last year, and that has led to the margin decline, because other than that, there doesn't seem to be any one-off, etc. If you guys have,
I think also in the power business, I just calculated it, but if it makes sense to you, 10.7% margins is what they've seen in the power business, compares to same time last year at about 14.5%.
Yeah,
so there's a big slide that we've seen there.
Yes, and that's one of the most important business of the company, because almost 70% of the revenue comes from the power business, and margin decline in that is something that would not go down well with the street. But with BHEL, there is always a caveat that there are a lot of one-offs. It is possible that the company comes out with some provisions or gives some details when it comes to the con call. But as of now, the headline numbers which are there on the screen do not look good. Absolutely,
down 6%. And I was just looking at the other income. The company has got an other income benefit of close to 50 crores, nearly 225 crores. This compares with 165, 167 crores year on year. So despite a 50 crore benefit coming in from the other income, the EBITDA has been so much lower than the street expectations that the net profit has been at around 190 crores. This versus our poll of 200 plus crores.
And in any case, BHEL is a stock that has only destroyed wealth for investors, right? I mean, if you pull up a 2, 3 or even 4-year chart, you'll see 2 years back the stock was, I think, 150 rupees, and look where the stock is now. So I think it's reasons like this, complete deterioration in operational performance maybe.
Well, yes, I remember when the stock was at 100, there was this big debate whether that new capex is coming in the power sector, and there were a lot of analysts that turned positive on the stock. But looks like that the company is not performing, and even on order inflow front, we have seen, yes, this quarter it is expected to be steady because they backed 2 orders worth around 6,000 odd crores. So order inflows might be steady, but for BHEL, the other important thing to watch out for, what is the executable order book, because a lot of it is stranded or stuck due to environmental clearance, etc. The receivables of the company continue to remain high. They haven't given the balance sheet details or the order book details, but the core operational performance of the balance sheet does not look good. Let's see if they come up with any surprise on the order inflow front or anything in the receivables front, but as of now, it doesn't look good.
All right, another stock which is not doing too well, Artica team might pull up, is SYMPHONY. They also reported their numbers, and that stock is down about 5% because it looks like it's a margin miss on their air cooling and other appliances business. Because if you take a look at the revenue out there, that's grown from 227 crores to about 243 crores, but the EBIT has actually halved from 85 crores to 45 crores. So that's telling you that there is some amount of margin pressure. Yesterday, another consumer durables company, Whirlpool, reported a margin miss. That stock's not doing too well, and looks like this continues for SYMPHONY as well. Stock down about 6%. Air cooling and other appliances out there, the revenue 243 crores. Margins looks like it's a miss because the EBIT has nearly halved.
Yeah, even if you look at the revenue number, does not look very impressive, and SYMPHONY has disappointed over the last couple of quarters, and we were hopeful that maybe going forward the company will surprise us, but looks like the street would become more nervous if this kind of performance continues, because as you mentioned, this quarter across the board that we have seen that there has been a margin pressure, but at least the top line growth had been strong. I'm not very sure of what the top line number for this company is, because at least that would give some respite, but other than that, the company has been disappointing quarter on quarter. Even if I look at the consolidated numbers, the top line is pretty much flattish, 250 crores versus 230 crores. So not that they have come out with any big bang number as far as the top line goes as well. And the profit at 37 crores versus 65 crores. So that's a definite depletion coming when it comes to the margins and the profits of the company. And clearly,
year on year, Anisha, from the press release that there is the EBITDA as a percentage of revenue has fallen from 40% to 22%.
Yeah, so and the big benefit for SYMPHONY Symphony was that the margins used to be really strong because they're the leader, they have that space. They always used to command that premium margin when it comes to the segment, and bringing it down almost to the 20-30% levels is something that we'll have to take more clarification on from the management, because there's no top line growth as well.
There's no top line growth. Even gross margins as a percentage of sales is now just sub 50% versus about 55% that they saw same time last year. So not looking good at all. Look at the stock, 6% gone now on Symphony. So two companies come out with their numbers a while back. BHEL and Symphony both reporting very disappointing numbers. On the margin front, BHEL 400 basis points fall in the power business margins and single-digit consolidated margins at 3%. Not looking good at all. In fact, the fag end of the earnings season, generally you get such casualties. But let's take a quick break on that note. Thanks, Anisha, for joining us. More market talk, though, lined up on the other side. The earnings as well will be in focus.
Well, we have numbers coming in. Symphony and BHEL not doing too well, and not doing too well either is Tata Global Beverages. While the revenue growth has come in higher by about 11%, the EBITDA has fallen by about 16%, which means a net profit decline of nearly 35 to 40%. The EBITDA, we're just trying to calculate that. Well, I think it's the net profit which is missed. And as per my calculations, the EBITDA has actually fallen 16%. So we'll take a note of that. The street definitely does not like these numbers. And just trying to calculate, I'm just unable. Okay, so year on year, EBITDA has actually come in lower. So we're just trying to figure out where that miss is. The stock is down about 3.5% as we speak.
In any case, it's an operational miss. That,
yep, it looks like an operational miss. We'll have to rework the numbers though. 11% growth on the top line, 16% decline on the EBITDA, and 35% decline on the net profit is what I'm calculating it as. But we'll try and recalculate some of those numbers again.
Okay, well, on that note, it's curtains down on Business Lunch, though. We will take up all this action forward on the other side of the break. So don't go anywhere. Mid-Cap Radar coming up next.